Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
And I'm Will.
So today, the duo of us is going to tackle the show. We are without Brian, but last week I promised we would have a surprise on the show, and the surprise is Memo's back, but you have a surprise. You have a story to tell us about your trip to Mammoth.
Yeah, well, you know what? It wasn't just Mammoth. Since Brian's not here, I had a...
Surprise on the show.
Broke my foot.
Broken foot in house. All you out in Mammoth, be careful of the new lift that is partially covered. It's icy.
Chair 16.
Chair 16.
Yeah, and it wasn't for kicking Brian.
Yeah.
I'm messing with that.
Yeah, we should have said that. Yeah, you kicked Brian's butt and broke your foot along the way.
Yeah, he's been working out.
So we're going to go through this week's housing-related news. We have 4 topics up this week. First one is bidding wars erupt as 2024 kicks off, with some listings seeing over 30 offers. Yahoo Finance brought us that one. Why the number of price cuts are dropping as housing inventory rises, coming from Housing Wire. We have U.S. serious mortgage delinquency rate falls to the lowest level since 1999, CoreLogic. And then U.S. annual rent growth holds at less than 3% in November. Now, right out the gate, I'm going to say, sorry, haters. There have been a lot of people in the comments that are expressing their opinion, and that's fine. And I've also said in previous episodes that there's a lot of validation to some of the feelings you have about the data you're citing and the way you are adamantly making your position known. And that's totally cool.
Yeah.
Articles like this and data like this backed by like CoreLogic and Altos Research is really hard to argue. And we're going to talk about some of that today. So the first one is the bidding wars. So bidding wars erupt as 2024 kicks off, with some new listings seeing over 30 offers. Improved mortgage rates means buyers are coming back, and that means competition. FOMO is one of the things that has been coming up in the comments, is like people should not be buying because of FOMO. I can, as a consumer behavioral psychologist, not a real title, I can say, I see that. Whether it's actually because people have FOMO or not really isn't that important to me, more than the affordability is and the math of it, and making sure that people who can't afford also have a shot at owning a home.
No, that's absolutely right. And when I say FOMO, I just learned that acronym yesterday, right? Fear of missing out.
Wow, that's awesome.
Yeah. You learn something new every day.
Yeah.
But Andy, it is. When rates are, October was brutal. I keep going back to October. It was brutal. It was very eerie, right? Rates went up. If affordability was already kicking your butt, at that 5.5%, 6.5% rate, now 7.5%, almost 8%. Whoa, that was just...
It was kind of like the body's already on the ground and it's already passed out, and then you get boot stomped on top of that.
Exactly.
That's what October felt like as far as rates and affordability is concerned. But here's the thing. And again, I know that in the comments you guys are right about the things you're trying to be right about.
Correct.
And I know that what we're saying here on the show is not universally true for every area. So we have to qualify that.
Like,
there are higher cost areas around the country that are just always higher cost regardless of what things look like. And then now it's even worse than that. But when affordability comes back in these high cost areas where people do make substantially more money than, let's say, the average person does in other parts of the country, it does mean that there's bidding wars. And that's exactly what we're seeing here.
Absolutely. No, and I'm in the trenches day to day. And I got to see the difference. I saw applications. We started getting more people wanting to get approved, get ready. So enough opportunity comes or the interest rates drop just a little bit, it makes a difference. We talked about when I had a client approved at 7.5 and now I'm going down to a 6.5, it was like an $80,000 difference in purchase price.
Yeah.
That actually brings up more homes, more opportunities for a client. And those are just the realities of it. So when people see that and they got approved at a certain rate and now because rates shifted lower by 1%, it puts them in a different category.
Yeah.
And I believe in the bidding wars again because we had a few offers accepted and there was like 10 offers. There was 15 offers on one. Mm-hmm. And luckily, again, this is where relationships do matter. When you set yourself apart from other lenders or other realtors and they get to see who you're working with, they're like, well, I'd rather take my chances here because I know they'll get the stuff, they'll get close. So I'm in no disagreement with this.
Yeah, and one of the things I want to make sure I say specifically about being here in San Diego where we're at is, and you've made this point on the show before, so for those of you who are new to the channel, you're going to hear this the first time, but those of you who've been around for a while, bear with me. You talk frequently about, to the south, we have the border, and Mexico's right there. We're not building or buying real estate down there. And to the west, there's the Pacific Ocean. We're not buying or building real estate there. And you get far enough east, you're eventually going to be in territory that is not buildable, either because it's preservation or you're eventually running into mountains.
That's right.
And you can't build there. So there's there's a little bit of a limited we're kind of boxed in a little bit in this corner of the universe.
And then to the north, you got the biggest naval base, one of the biggest naval bases.
Yeah, you got Camp Pendleton, and that brings up my point here too. Is that in consideration alongside with the size of San Diego's military presence means that when people have BAH levels that are increased and cost adjusted for cost of living, and you have interest rates go down, us as a VA specialist, when it comes to doing mortgages for purchase and refinance, those things all together mean if affordability has eased, that means more people can afford because their BAH has been adjusted upwards to meet the cost of living where it's at.
And you know where it makes a difference is when both
at the same
husband
time.
and wife spouse are dual military.
Yes.
They both get what's called that BAH, a basic allowance for housing. So one that we just did, it was $4,200
A piece?
Exactly. When you're married, one has a lesser. It's like if they're single, right?
Right.
But the other one, as a married, they claim dependent, and so therefore their BAH is a little higher.
So,
but it's 42, and the other one's 3,400.
Okay, so that's $7,600.
There you go.
So wait, 42 and what?
42 and like $3,400 is what it is.
So yeah, $7,600.
Absolutely. I'm glad that you're good at math.
No, but okay, but this is what I'm talking about. Like, and I understand, again, back to the comment. People are like, hey, no one can afford that. That's not always true depending on where you're at, where you're watching from, and what your situation is. Now, it's also not to say that you can't get there. These are situations where you're talking about married. If you're getting $4,200 on one spouse and then $3,400 on the other, they've done some years. These are not your first, second, third year active duty military. Let's qualify that too.
Exactly.
But $7,600 for a house.
Correct.
That is a tremendous amount of money that can go towards qualification, especially when it comes to VA.
Yeah. I mean, right now we got one approved. It's $470 purchase price, and it's just single. Married with one dependent.
Wow. Okay.
Wife doesn't work, and they got into a $470,000 home with a $300 HOA.
See, and the thing is, like, I know, and I'm glad you're saying this from like I'll say the front lines, from like being in the trenches, because I understand from the outside looking in that there are some times where you go, well, yeah, you're supposed to say that you guys sell loans, or you're supposed to say that you're a realtor. Now's a great time to buy. Now's a great time to sell. Anytime's a great time to buy or sell. Okay, fine. I understand the used car salesman argument of how people have normally been treated in this industry. You can't. I don't know a lot of used car salesmen that have been in the business in used cars for 18 years, and I don't honestly know a lot of realtors or mortgage lenders that stay in business that long if that's how you treat it. So I think that there's a qualified level of advice here that people are taking because they're looking at their own long view picture. If you are just new to our channel, we have a new show in 2024 called Friends of Mortgage Heroes. And one of our earliest episodes is with our friend Lloyd Stanford. And Lloyd did 32 years in the United States military, and he is a realtor. And he said, when we asked him, if you could talk to people in active duty right now and give them one piece of advice, what would you do? He said, start buying real estate sooner in your career. And if you can, buy and hold and buy in every place you go. Buy in every place you go. And he qualified this. He and his wife T have bought 4 homes they bought 4 homes during his active duty time.
Correct. He just wished he could have done more.
Yeah. And so that was what he said.
Exactly.
And people are going, oh, well, yeah, but he's a realtor now. Okay. Look, he still bought and sold 4 homes. So if you've bought more than 4 homes, then clap back at Lloyd in the comments. If you've bought less than 4 homes, don't say nothing.
Yeah. I mean, and here it is. When we're getting the feedback, it's all good. It's what it is.
It is. I say this in jest, you guys. I don't really mean go away.
It's all good. We all have our opinions. We all get it. Every area is going to be performing differently.
Yeah.
There was a point in time where I'm going to say LA was the most expensive place. New York was it. And now here we are in San Diego.
Yeah.
I've never thought that being raised and born here in San Diego that would be the case, but it is the case right now. In the nation, we're one of the most expensive places to purchase a home. Well, and I'll tell you, one of the things is buying a home $1 million. When I was growing up, I looked at a home $1 million, looked like $1 million. It was like a big mansion. And now what you see for $1 million, I agree with everybody. It shouldn't look like that.
Yeah. Yeah, it's like a regular ass house. Yeah.
Very regular. Very regular. Well, I'm going to say it's got to be like a 3-4 bedroom home. And it's just, again, depending where you're at.
And I was driving down the west side the other day, and I was going to the mechanic and doing the optometrist stuff over there, and get myself some new glasses, some new nerd glasses, so I can match the emoji I send you all the time during the week. And, they have the new building complex going down by the bayfront. And, it is I forgot this, and I was reminded, it is the largest hotel construction construction project in the country.
In the country
currently.
right now, correct.
And so, we're talking about San Diego being the most expensive place to live by a couple different measurements. But then we also now have in Chula Vista on the west side, on the bayfront, the largest commercial hotel development happening with the convention center coming, plus residential homes, plus restaurants, plus event center, all sorts of things. So this place specifically is going to be more densely populated. New inventory is going to be coming on the market, but it's not going to be new inventory that's going to be fire sold. This is going to be new inventory that's going to be at market price, at market value, or even nudged upwards because of a commercial uplift in that area.
I'm so excited. I'm not used to seeing like these big old cranes.
Isn't it crazy?
In Chula Vista, I go by there, it's like these big old cranes. Like what?
You go downtown and you see that. Like you see, oh, there's a new building, or that one's being renovated, or whatever. This is happening like 5 miles from our. It's pretty cool. But
pretty cool.
But yeah, bidding wars are erupting.
I agree with this.
And it's because of all that stuff. So
and it's going to continue happening right now. Again, I always say simple economics. Something I learned in. That's about the only thing I learned in college.
I mean, yeah, when you distill it, unless you're going to be an economist, you probably don't need to know much more than that. But
there you go.
This kind of also goes hand in hand. I'm flipping through my pages because literally this goes hand in hand with the next topic, which is about the number of price cuts that are happening as far as percentage. So this is from Housing Wire. Why the number of price cuts are dropping as housing inventory rises. On a previous Monday Mortgage Minute and podcast, I was talking about how the average range for percentage of listings that had a price cut was between 30% and 35%. And in 2023, it was just outside that range. It was like 36.2 or something like that. It was just north of the normal range, but they're saying normal is 30 to 35% of listings take a price cut. And the projection for this year is 32.2%. So we're saying that in this year that the sky is falling and everything's going to collapse and burn to the ground, that you're also going to have fewer homes have price cuts this year than last year. And then the bidding war thing with lower rates and affordability for some coming back, I don't know how we can look at this and say it's going to be otherwise.
Yeah. I mean,
Black Swan event excluded. What am I missing here?
We're not. And again, thanks to Alto's research, they're giving us this great data. It's checking how many homes are pending, price drops, sold homes, etc. So it's giving us this great data.
Yeah.
And so we are seeing a lot more homes becoming available more so than last year at the same time.
Yeah.
Which is good. It's actually good news for all of us.
It is. Well, because because we had the tightest inventory in decades in 2023. So we talked about kind of the lull and the ditch of available home sales or available homes for sale being their lowest in decades back in 2023. And then we're going to see this kind of thawing out and this resurgence, inclement weather notwithstanding. I know half the country's under snow right now, or like extremely frigid cold weather. But even then, what you're seeing is that this week, year over year, from last year, listings are up by 10%.
I know, that's crazy, isn't it?
So you saw this same week last year, in 2023, you had listings of 36,804, and in 2024, it's 39,640. So it's a 3,000 listings for the better, which is 10% more than it was this exact same time last year.
Which is good.
And
that's something that Altos actually discussed. That was in November.
Yeah, and they said, look for this.
Exactly, look for this. Starting the new year, we're going to have a little more. And sure enough, that guy just hits it. He hits it.
And I'm going to say this too, because I know that I'm starting to see and witness and learn that the people watch our show have not only a variety of opinions, which is awesome to hear and then exchange. And that's been really fun. But I know also some people are watching some other things that you and I watch. And we look at what is the percentage of corporate owned homes, how many hedge funds are starting to own residential real estate. There are places that are blocking funds from buying residential real estate out from underneath let's say the citizens, if you will, so that these corporations can't just be buying them. And that's not in this article, but that I think is also going on in people's heads. And they're going, hey, look, if I don't buy this, I'm going to be a permanent renter forever, and I don't want to be. So whether you want to say is that built-in American dream, like American dream is to own a home. Okay, it might be that. It might be I'm sick of paying rent. I'm paying $4,000 a month in rent. Might as well pay $4,000 for a home. It could be that. It could be I'd rather own it than some BlackRock company owning it. It could be that too. It could be your own other reasons too. But I'm just listing off some here that I think this is why you're going to see this continue, and there will not be as many price cuts this year as last year.
Yeah, I agree.
Tell me I'm wrong.
Unfortunate.
Tell me I'm wrong and tell me why.
You're wrong. You're wrong. No, it's absolutely true, Andy. There's just, again, so much data out there, and we just got to go with what's happening.
And the thing is, like, the bidding wars aren't down. You know, the bidding wars are on the way up. It's not bidding the buyers. It's not bidding the sellers down. It's bidding the buyers, bidding the sellers up. You know, purchase applications are increasing.
Yeah.
Refinance even, which has nothing to do with this. They're up too.
Yeah.
Which means I think people need some financial help. That's a different conversation. But purchase application data going up week over week, month over month, quarter over quarter is also key for this because mortgage rates went down and more people are like, okay, now I'm back in the game. I want to get in the game and I want to do this again because I think the dip has been the dip.
Yeah. I'm going to share one story that we're going through with this. You know, also it's strategic how the realtor, what sales price they put on the home, right?
That's a lot of times. Good point.
A lot of times is they'll put it low to create a bidding war. For instance, here in San Miguel, they put one at $899, which was a 4-bedroom, 3-bath, 1,800 square feet, right?
Too low.
It was $899.
Yeah.
You know, and so I actually called in because my realtor partner was had a family emergency. So I called in to just kind of fish a little, right? And I said, hey, I can't announce, realtors' names, but the person that had it listed, I asked him, like, my client wants to put a 905 with $10,000 in closing cost credit. Is that something your seller would be willing to entertain? And she's like, oh no, that would be way at the bottom. And I go, you know what? I was actually suggesting to the client that they submit at 930 with no appraisal contingency. And I go, well, that would have been a contender. And she goes, no, we're right above $1 million with no appraisal contingency with the 10-day close.
Okay, so go into that. So explain to people who may not know what this tactic is, why they do that.
Yeah, so it creates a bidding war. People see, oh, I can go into this house that's actually really worth $950, $980. So maybe I can net my seller more.
Yeah.
And so they strategically put it, making it look like, oh, maybe something's wrong with the property, but let me take a look at it. And then they go in there and the house is beautiful. It's actually just been remodeled.
Yeah.
So that just creates people to want to go in there and bid more and have that fear of missing out that I need to put my highest and best offer.
And I know that in the past this has been true, and I know that it's probably a little bit true today still. I don't know to what degree or by what percentage, but when you say you list something at $899, it's because you're trying to keep it under $900,000. And if people have a search criteria up that says, oh, I can purchase a house and I can afford up to $900,000, that brings this house that's maybe worth $950,000 or $1 million into that search criteria, so you see it. But then it does stir that up, and it brings lots of people to the with their little paddleboard bidding it up. 905, 906, 910, 915. So you're sucking in the person who doesn't necessarily actually qualify that, or I shouldn't say that. They maybe don't qualify or are unwilling to.
Yeah.
And then it also may shove them into the direction of, you really want this house. What are you going to do to make this work? What are you going to do to make 980 work, 950 work? And then they figure something out.
Yeah. It's just strategies.
Yeah.
Strategy.
So you're saying in this example, it was $899 on list price. They got the bidding war up and it was up to $1 million. What do you say? $1 million?
A little above $1 million. Obviously they can't tell you the price, but
well, of course
she says we have a little bit. Oh, it's just above the $1 million mark with no appraisal contingency.
Wow, that's crazy.
What does that mean? If the value came in at 980, the appraisal, that buyer is willing to fill the gap. Yeah.
Okay. Yeah. They're going to fill the gap. But also, well, yes, but also I'm willing to bet if I'm thinking of the neighborhood, it might not underappraise either.
No.
It's going to come in at value.
Maybe.
It's going to come in at value because there's not that many sales happening over there.
I ran the comparables. I'm thinking personally 960, 980.
Yeah. Okay. Well, then they might come in with that difference of 20 grand or whatever, 30 if it is, because it's worth it at that point. The person, if they're qualifying, probably has that much money anyways.
And Andy, that's what happens when you see the rates go, they're here, and then it changes a little bit. It gets people motivated. It gets people like, I got to go out there and take advantage of this opportunity.
Yeah.
And so that's what I believe we're seeing here right now in San Diego.
Yeah. So you're saying it's partially or potentially a little bit of a self-fulfilling prophecy?
Absolutely. Yeah.
Yeah. Okay.
Why not?
Yeah. Why not? I don't know what else it's going to be. So it's wrong with that. Yeah. And I know I speak in the technical terms a little bit or frequently. I said a little bit. Yeah. Right.
A little bit.
I'm speaking in technical terms all the time or technical ways all the time. But, it is, I think we're going to see that at large as well.
Yeah.
I do think there's this undertone of I better get into a home. Otherwise I may never. And, last week on the show, Brian and I talked about the different buyer behavior of Gen Z. and that it is different than our generation and the generation before us, but that they are also still seeking the opportunity. It may not be because I want a white picket fence, I want to have my house and raise my kids there. They may want it from cash flow and freedom of financial not responsibility, freedom of having to just slave away in order to make money and let something passively make money. But that still makes them a buyer, was my point to Brian. Like, they're still buying the place.
Yeah. These new buyers are looking at different. They're looking at more long-term investment, not a forever home.
Yeah.
You know, in my generation, it's like, this is probably going to be my forever home.
Yeah.
You know, I know my mom would buy a home and it's like, I'm going to stay here forever.
Yep.
You know, it's a commitment. I got into it. Now I got to stay there and fulfill my commitment.
Yeah.
You know, and then you get comfortable. It's like, why not?
Yeah.
My payment's lower. Instead of going somewhere else and starting all over, it's like, you know, there's a misconception mentality that you'll start all over and why do that again?
Yeah.
You know, and so now this new generation with having your TikTok, your Instagram and all that, seeing all these people where you buy the home, is that for your forever home? Obviously it does get that in your head.
Changing that approach angle.
Exactly.
And I saw, you know, we had a really awesome comment from a new subscriber this month, which was saying like, hey, home prices need to crash 40% before people can get back in. And I understand the argument. The issue I contend with, and I think that we were seeing this, is people are also afraid that if they wait for that, they'll never get in.
Yeah.
So if prices correct 20%, you guarantee that I can guarantee you that at a 20% drop, before we even get to a 40%, there's someone with cash going, I'll take it. I'll take it at 80 cents on the dollar versus 60 cents because I'm not sure if we're going to get down to 60 cents. So I think that you can always get undercut or cut off at the pass by someone else who's willing to buy it at 20% off versus 40 and wait, because at some point you're going to end up missing out. And I think that's the risk. So I understand the comment. I totally mathematically understand the argument. I agree with you on that part.
100%.
Behaviorally, I don't think you're going to see that because someone's going to step in sooner and snag it.
There's always somebody that feels like, I like it, I'm taking it.
Yeah, that's right.
And I'm willing to just commit to it and ride the wave out. You know? So, but 100% agree with that comment.
Well, let's go to the next thing, which, again, this is probably going to ruffle from some feathers because people want to see something different than what the data is showing. But U.S. serious mortgage delinquency rate falls to lowest level since 1999.
Wow.
Okay. Admittedly, we were not in the business in 1999. We started in 2005. So, you know, we only have 19 years under our belt.
Yeah, I was pretty born.
But okay. Conventional NFHA serious mortgage delinquency rates are lower than pre-pandemic levels. Highlight that, pre-pandemic levels, but numbers for VA loans are slightly higher. That's weird to me because typically, historically, VA has been much lower because of how kind of, let's say, baked in it is with BAH and all that. And it's not just active duty to get BAH. I know it's veterans that are separated already too. But the fact that it's the lowest since 1999, that's even before the collapse when money was basically given for free and at the lowest price it ever was from a DTI perspective, debt to income ratio. Yeah. So remember when it was like, interest only loans or neg-am payment loans? Like, yes, that whole thing blew up in the industry's face and the nation's face and the globe's face
meltdown.
And the earth's face and all that. But here's my point in saying that is that the mortgage delinquency rate now is lower than then, and they were less expensive proportionately then. This, to me, is a little bit of an anomaly, or a lot of an anomaly. Let me put it that way. This is an anomaly to me.
Yeah, I don't know. I don't get it, but
here's the thing.
How is it possible?
Here's why you don't get it, because we don't actually have delinquencies with people. That actually is true. I know that's not true. Everyone has it. Listen. There's always a way out when you own a home, and delinquency is not always the first selection of options, and it is usually the last, and it's usually after you've exhausted every other resource.
Yeah, and here's the thing, Andy, you know, I do understand it. We have the highest equity bill ever to be recorded in history. So people are sitting on a lot of equity. So how are we going to have this and you're going to say, oh, I'm delinquent, I'm just going to let my house go? There's solutions that you can find by getting a line of credit, getting a private money to go in there and loan you money before it goes delinquent. And remember,
you know, a larger percentage of homeowners now have a rate, let's say 3%, 3.5%, 2.25%. Some of our VAs back in just a couple of years ago.
Exactly.
So there should be lower delinquency rates because when is the last time you ever saw a 2.5 or 3 or 3.5 fixed 30-year loan? someone who's delinquent on that has something else going on,
Yeah.
but they have the equity to probably cure it or get out of it or sell it.
That's it.
Versus deal with having to go through delinquency and NOD and then lose the house.
Yeah, they have options.
There are options. So if you are watching this and you catch this segment or you catch this clip after the fact and you are staring down delinquency and you have questions, you can write your question in the comment box, or you can go to our website and put your comment there. I learned our email addresses being sent out to you guys is not working. YouTube hates that.
Yeah.
So new lesson learned on the show. But if you actually are facing delinquency and you're looking for some sort of solution, please let us help you answer some questions.
Yeah, and contact your lender, your current servicer.
That's right.
Back in the day, 2020, COVID happened, and you were able to do a forbearance on your payment for 12 months. 3 long years ago. And then you were able to do a forbearance, and they did it for only 6 months it was. Then they extended it for a year. Then it was like 2 years.
Right.
So what they did is they ended up doing a loan modification afterwards.
Yeah. That's that sharp decline on the chart where it just like falls off a cliff.
Exactly. But that's how we see that, And so here's the thing. Before you even go, the servicer doesn't want to see you not being able to pay, So they're going to work with you some way at some capacity.
Yeah.
So just give them a call. Figure out best solution possible. And I think that's what's happening here.
Yeah.
If COVID's taught us anything, hey, it taught banks that you can't collect money. You got to go in forbearance. But what happens to that different? It gets tacked on later.
Yeah.
So when you do your loan modification, let's just say you owe $300,000 and you were not delinquent, couldn't make your payments because of job. And, a lot of times you had to stay home no matter what. Let's just say your payment was $1,000. That $12,000 would get tacked onto your loan, or it'd be a silent second. You don't pay no interest or anything, and that's something the government was mandated.
And in a lot of cases, in this example, you're saying it's $300,000, and let's say you have $12,000 that was deferred or tacked on later.
Yes.
Okay, so you owe $312 now, but your property that went up 40% in the same time
exactly
is not worth $300,000 anymore.
That's leverage at its best.
It's worth more like $420, $425, $450. That's a different conversation. So you gained equity, even though you had to tack that on. Again, I know this is not everyone's situation. And like, oh, you're saying that because you guys sell loans. Okay, fine. But look, here's the thing. On the chart, it shows that this is actually still trending downward. It's not like it was a ball that got thrown up and it came back down the same spot. It's still in that spot lower than it ever had been in the last 25 years. And it's still trending downward. I think this is going to continue. I think the biggest threat to this is jobs and the economy at large.
And we're at the lowest unemployment rate.
Exactly.
Even with the high interest rates, inflation, what it was, unemployment's still at a historical low.
Yeah. So I was thinking about this. So I was having a conversation, and I didn't know this was going to come up on the show, but since you brought it up, I'm going to say this. I had this conversation. It was around the concept of ghost unemployment, where jobs just go away permanently. And yes, you're on unemployment, but then when your unemployment runs out, it's just ghost unemployment and it's gone. And it's because that job doesn't exist anymore, or that job's been replaced by whatever or whoever, and then that is now the issue. I think that could be something we look at. But again, the delinquency doesn't have to happen. If you have equity and you find yourself without work and your job is never going to come back again, then you can still sell your place.
Yeah, and there it is. Hey.
Yeah.
As have mortgage modification programs offered to those who were in forbearance. It works.
Yep.
I'm telling you. We found a solution there. How do we get people not to freaking get NODs, which is a notice of default?
Notice of default.
Let's just work with them and modify that loan.
Help them out.
That's it. Why not?
Well, we have U.S. annual rent growth holds at less than 3% in November, so November 2023. This is coming from CoreLogic, another great research firm. I shouldn't say just research firm. Their research is great. And they're reporting out here, U.S. single-family rent growth increased by 2.7% year over year in November, in line with numbers recorded since the summer of 2023. Attached rents grew by 3.3%, and detached single-family rental costs grew by 2.3%. So a little disparity between attached and detached. And among major U.S. metro areas, San Diego posted the nation's largest year-over-year rent gain in November, while both Austin, Texas, and Miami saw annual gain declines, which is weird. But I actually have an explanation for that. Appreciation in lower-priced rental tiers continue to lead the nation at 2.9%. So here's why I like this. Number one, if you've been able to maintain rent at this elevated level post-pandemic, then you are a likely candidate to be able to afford a home at that same monthly expense. And of course, I also like that there's this kind of like sweet spot between that comment and the next one, which is if we can keep the rent increase lower than overall inflation, then I think that's going to help our affordability mathematically at large across the country. It's math, right?
Yeah.
Sorry.
Yeah.
Math. We need an actual mathematician
You
here.
are.
Because I'm not here doing like the calculator stuff. But some of this is I don't want this to come across as guesswork.
No.
I'm not just coming up here winging it. This is all well thought out.
Here's the thing that I love about data. Well, last year, it was like doom and gloom for rents. They're gonna go down. It's gonna crash. It's gonna. But we're looking at the data here. What happened? How is it a big turn event in a positive way for rents? I mean, I'm not for it. I own several properties. I'm not one of those to go, hey, rents are up. I just don't do that. I try to be as fair as I can with my tenants. And that's why I've had them. I mean, one of my properties is since 2009. Been renting my same property a long time, I just try not to be that one. But I was worried for a time when I was reading and I was not paying attention to the data. I thought, Andy, I'm going to lose out here. My rent is not going to make any sense. What's going to happen here? Listen, it's been nothing but gone up.
Yeah, and it's even quoted in here. More than 3 years of increasing U.S. single-family rents and the rising cost of other goods have made many renters sensitive to the cost of living. That's it. That's it in a summary, in a nutshell, right there. But this is 3 years of that, and I think this is part of the explanation for me mentioning at the top of this section the Austin, Texas, and Miami saw annual declines because they're declining from ungodly astronomical increases. So if something went up 30% year over year and then declines 10, you are still way up by a lot. So I know San Diego seems to be the anomaly. Once again, San Diego is this anomaly in a lot of housing and real estate data, which is interesting that we're also doing this show at the same time. But I think specifically for Austin, Texas, and for Miami, Florida, the annual declines is just that. It's during that time, of these 3 years, so many people migrated to Texas and to Florida. And it just shoved up a lot of that rental increase. And it wasn't just everyone buying homes out there that was causing home prices to rise at the lowest interest rates we've ever seen in our life, but the rent as well. And I think this is just some cooling off of that, which again, I'm saying cooling off barely compared to the astronomical levels that they were at.
Exactly. It's crazy. I mean, hey, some of those buildings in Florida are pretty crazy. That Porsche building.
Oh, yeah. Oh, man.
It's pretty nuts,
I would
right?
love to do an entire show just looking at like a reaction video, just watching all the cool stuff that they're doing with
My understanding is that you drive your vehicle in to the garage and then an elevator puts you all the way
up to your place. Yeah.
That's crazy.
Yeah. Wait, is it the Porsche building or is it Bentley? Was it Bentley?
I don't know. I remember
Aston
Martin.
Now I'm tripping out. Was it Porsche?
I don't know.
Oh, Porsche.
There's one of that. That's how much money they got.
Wait, is it Nissan? Let's just name every car manufacturer. Is it Nissan, Toyota, Lexus?
Not that.
No, it's
For
not
sure.
Chevy. It's not the GMC building. No, Dodge. Okay. So we got. I'm going to go back to another part of our show we just did, which was we were talking about delinquency rate being the lowest. This chart of the rent index year over year going back down looks very much like the delinquency. It is lower now than it was back when we saw before the housing collapse of 2008 and 9, and obviously from the peak back in the 2020, 2021. So
it like almost mirrors that.
You can almost overlap the delinquency rate and the year-over-year percentage of rate change for the rental index, and they look almost exactly the same. It's kind of trippy.
Yeah.
So
there you go. We'll put those. It's pretty wild.
It's very interesting. I mean, there's a huge dip on the rental side when it comes to 08, 9, and 10. Which actually correlates with not delinquencies, but it correlates with the home price index. But it's funny that the delinquency rate and the rental index are actually pretty darn close for this last 15 years, I'd say. So as far as rent is concerned, I think they're going to remain elevated. I think that's just, that's what the market's calling for. That's the market rate. The market rate's the market rate.
And here's another thing, Andy, that I like to add to all of this and why it's so important with this for people to understand data and why we share this. When we're looking at a person that's looking to purchase a home, especially since we represent a lot of military, every 3 to 4 years, they're getting orders to go elsewhere. So it's so important to have this data in front of you now to see, hey, this is not my forever home because it can't be. I barely got in the military. I'm like 5 years, 8 years, 10 years. I'm going to get orders in another 3, 4 years. What can I do with this property? Well, guess what? We can rent it out, right? Hopefully it offsets the mortgage payment with that. And now we can help them purchase another, finance another home elsewhere with a PCS.
Yeah.
Our whole goal is just to understand data so that they can get the proper information and encouragement to go out there
make a choice
and invest, make a choice, have a choice, allow yourself to make the best decision possible.
I like that you said that, because I know we dispel, I don't say it this way, but it really is honestly dispelling the myth that like you're just trying to sell people into the greatest debt of their life and sell them a home. And that's like, look, we don't hold a gun to anyone's head for them to buy a home. If they want to buy a home, we're going to help them. If they don't want to buy, fine. I honestly could care less if they don't want to buy a house, because if that's not good for them, then I kind of don't want to do it. I really don't. And the people, that's terrible business. Well, okay, you're also saying it's terrible business that you're basically talking like we force people into homes, which we can't.
Oh, yeah, we can't.
We can't do that. People are making their own choices. I like that you say it that way, because it's people making informed choices about what their options are, what they can and can't do, why they should or shouldn't, and then they make their choice. Yeah. When they're ready to go, we go. We're their running mate when they ask us to be.
Hey, it's simple mathematics, right? If the numbers make sense, then there you go. You make that decision, based on that.
So on the last part in this article, the single-family rent change for selected geographic areas does have San Diego, Carlsbad right there, positioned at the top. So the November 2023 single-family year-over-year rent change, 5.6%. And the October median rent price, $3,899. Here's what's interesting to me. The second listed on this list of places is Minneapolis. Yeah, and Bloomington, Wisconsin. I'm not so surprised by number 3, Boston. Yeah. Number 4, San Francisco. Number 5, New York. Number 6, urban Honolulu in Hawaii. Okay. Number 7, St. Louis, Missouri. Houston, Detroit, Charlotte, Tucson, Orlando, Los Angeles, Seattle, Dallas, Las Vegas. That all makes sense to me. Yeah. Where is Minneapolis coming from? That is different, because that is not on this chart. That's actually not on a lot of other CoreLogic charts. So something is happening up there in Minnesota and in Wisconsin.
Yeah, people are migrating.
So. All right. Well, Memo, thank you so much for another great show. Thanks for joining me today to go over this. I'm glad that it was just you and me today. Brian, I love you, but I did the show with you last week. Now I did the show with you. Maybe you guys could do a show together.
Yeah.
All right. Well, thank you all for watching the Mortgage Heroes podcast. Remember to like the video, subscribe to the channel, turn on notifications so you catch every episode, and we will see you again next week.
Yeah, please continue to share your feedback. We don't want everybody to agree with us, but at the same time, challenge us so we understand. I always accept the challenge.
I love answering the questions in the comment box. I love getting in there and answering certain things, and also hearing different perspective and opinions.
Absolutely.
It does help us kind of go, okay, well, this is who's watching and who's listening. Let's address some of those things and talk about them too.
We want to make sure that we acknowledge everybody's opinion and go with that. I love it. So no, thank you, Andy. And I'm glad that they continue sharing, continue to share this information. So thank you.
We'll see you all again next week.
See ya.